Onto the US data.
Yeah, we've got this, not great with reformatting here, but we've got our Michigan Consumer Sentiment Index out today. It's probably going to hold. We had strong numbers last time that it kind of held up a bit at 94.6. We're going to see the same again today, but the kind of main, it's a bit of a quiet day today in the US. But we're going to see Esther George speak, the Kansas City Fed president. I mean, we saw
the Kansas City Fed is perhaps not the pivotal one in the central bank stage.
But I mean, when we're looking at the kind of the overall kind of trends, I think it's going to follow what we heard Jerome Powell say, who's a voting FOMC member yesterday. And this is another kind of expected to be another slightly hawkish speech. I mean, Esther George said earlier in the year that, I mean, she was the one pushing for a June rate hike. And pushing for this kind of normalization of rate hikes, rather than saying that the risk is that if we start to wait until, I mean, we talk about the data-driven Fed, we've already got these strong jobs numbers. We've got employment at 5.5, unemployment at 5.5%. That's pretty close to that kind of natural rate of full employment. So that's kind of taken care of. The next one, as far as data-driven Fed goes, is getting towards this 2% inflation target rate. But George has said, if we wait too long before we start to try and hit that point, we're going to have to make up for it. The US is going to have to start making up for it with a load of hikes in succession. And it's maybe better to hike now and normalize.
Almost like when you don't really need to.
Yeah, I mean the case is, and it's lots of people have been making this case, that we need a normalization of interest rate policy. It's been so long since we saw rate hikes. We need to get the markets back used to anticipating them and getting back used to normal monetary policy.